Trade fears putting a target on one of the hottest areas of the market this year, the consumer. Stocks like L Brands, Dollar Tree, Nordstrom, Gap, and Best Buy getting hit today as a number of firms warn retail may be one of the biggest victims of China tariff hikes. But some may be safe. Credit Suisse and UBS arguing names with lower tariff exposure and pricing power like Lululemon, Nike, Walmart, and Target may be able to withstand the pressure. Which ones are you looking at, Karen?
Well, I have Target. I like Target. I think they're doing the right things. I mean, it'll hurt them a little, but I don't think a lot. The other one that I am long and has been painful the last couple of weeks is Capri Holdings, which I think, well, they do business in China. They sell in China. They have actually been really shifting their sourcing away from China and actually a lot of it towards Italy. So I think this one has really been excessively hit, but you know, in a bad tape like this. By the way, some options action there I did see. Not really my area of expertise. It's these guys, but there was some big call buying there today. I like it. I think it's really overdone, but it's clearly not trading well in this tape.
Mm-hmm. Pete, you mentioned Nike before.
Yeah, I mentioned Nike. Nike's one of them. Also Lululemon, which I've owned for a long time. I owned it a little bit before a pitch where I got slaughtered, and this thing just continues to make its way higher, Mel. I don't think people fully understand what the breakdown is. 72% of it is in the U.S. The rest of it international, but a lot of that is Canada. Then all of a sudden you can spread a little bit over into the Asian markets as well. But there's some metrics they were talking about in terms of the costs because of China. I think it was the UBS was alluding to that. And it's very minimal. So there's a lot of reasons why Lulu and Nike can still work, even though they're in an area that a lot of people would say, you know what, footwear and apparel and all the rest of that, you got to stay away from it. These two names, I think, can still do well. Does it worry you, though,
when Nike reported in March, the stocks sold off, I think, 5-6% the day after. North American sales were worse than expected. Yeah. They did see, to the point about pricing, the ability to pass through prices, they did have expanding margins, I think, globally, so that was good. But to me, do you want to buy a stock like this that's round-tripping back towards that gap? Don't you want to let it come in a little bit? I don't think you have to buy it on that.
I would love to say yes, and you and I both know, but when you see the options coming in and people start buying, that's the trigger. I'm waiting for that opportunity, and I see somebody putting big dollars down. I want to follow along with something like that.
I think the important thing is, obviously, you can pick individual stocks, but there is a great myth in the market that somehow the consumer discretionary space has been a winner, and it is not a winner, right? So just have to be very clear about that. The sector is, quote, outperforming the market because it's dominated by a handful of names: Starbucks, Home Depot, Costco. If you look at the S&P consumer discretionary sector, equal weight, it underperformed the S&P in 2015, and again in 16, and again in 17, and again in 18. It is literally straight down. The consumer is a disaster.
Yeah, just look at the XRT, disaster. Though. The retail ETF that's been trading between 44 and 46 for 4 months
and for 3 years going sideways, which is underperforming the equity. So there is no outperformance in the consumer space. None. It's a handful of names. Starbucks, sure. Costco, Home Depot, the champions. But the rest
But that's the beauty of the market, man, is being stock specific.
Right.
That's the world I want to be in.
I would
Instead
go
of
with
an
Walmart.
ETF.
I'd go with McDonald's, things that are defensive.
All right.